Welcome back to our April video. Ryan here with Mike, and we're going to be talking about some core investing principles that drive long-term success. Investing isn't about picking one stock or timing the market. Long-term success really comes down to a few core principles.
What it boils down to is fundamentals matter the most. And I would also say simple concepts as well. It doesn't have to be complex, but these are often overlooked.
Our first point here is compounding, and returns generate returns over time. That's really the key of this. The time matters more than the starting amount necessarily does. Time is on your side and is your friend when it comes to investing.
Yeah, I think Albert Einstein actually said it. Compounding interest is the eighth wonder of the world. So, and I would say the other piece to that, first is compounding, but the other one is consistency. So next one is diversification. We can't just rely on one investment or one outcome. When you go to the golf course, obviously you're bringing multiple clubs for each hole, depending on the shot.
Yep.
Similar sort of concept with investing.
Mix of asset classes, mix of geographies, mix of vehicles. That's not going to eliminate risk, right? That's impossible to do, but it can certainly help to mitigate some of that risk by spreading things around.
I'm glad that you mentioned risk, because there's lots of different risks. So a lot of clients think it's just market risk, but there's market risk, interest rate risk, purchasing power risk, or the risk of inflation, liquidity risk, credit risk, currency risk, geopolitical. I can go on and on and on. And the reason why we have it is diversify some of those risks away.
At the end of the day, the portfolio needs to align with three different things: your goals, your time horizon, and your comfort with risk overall. Time horizon is number 4 here. Short versus long-term goals should be treated differently. You should have dollars mixed up in different spaces depending on what the goal is for those dollars.
The biggest mistakes that investors make is that reacting to that short-term noise, sometimes the change in the portfolio creates more harm than good. And that leads to investor behavior, right? So behavior impacts rates of return more than just the market. There's a Dalbar study out there. You guys can Google it, where it shows the average investor makes a lot less rate of return than what the market overall makes.
And that's really the key, right? Timing the market is very challenging to do. There are investors out there who do this every day and still struggle to do it. Taking out those emotional decisions, trying to avoid frequent changes, that's really what we help you focus on and get pinned down.
Staying disciplined, staying consistent. Those are the two things that really matter most, and just, staying in the market. I think that wraps it up for today, and we'll see you on the next video. I think that wraps it up.